Hello and welcome to A Few Minutes with Marcia. Today we're going to talk about the Federal Reserve's announcement that they're not changing interest rates, which they came out with last week, and whether that was a good thing or whether they made a mistake. So as you listen to my remarks, remember they are just my opinions and shouldn't be used for investment advice. And most of the information I'm sharing with you today comes directly from the Federal Reserve website. So on June 19th, the Fed decided to keep interest rates the same. Screw up or wisdom? Well, let's try and put ourselves in the shoes of the Fed to decide why they would make such a decision. So their job, if you remember your high school civics, is to keep inflation stable, keep prices stable, and to keep people employed. That is what they're here to do. So basically, they're going to need to watch the economy and see whether the economy is strong and that those two things are taken care of. And if we look at slide 4, you can see, yes, disposable income is strong, hourly earnings are moving up, and initial claims for unemployment are the lowest they've been in decades. So as far as those measures of the economy, we're doing fine. Why are they cautious? Well, business investment is slow because businesses aren't sure where the trade tariff talks are going to end up, so they're a little bit nervous. And also global growth is falling, and again, largely related to these tariff wars. So there's definitely some things to be worried about, but the U.S. economy, if you look at it just by itself, is fine. Now, why might the Fed be cautious about changing rates? Well, take a look at the slide 5 where we see inflation and we see unemployment again. So unemployment's really low. Inflation has been going up, which means they should be raising rates, which is what they told us at the end of last year, but then it stumbles a little bit over here. It stumbles because oil prices are going down and there's their own supply and demand dynamics for that. But the interesting thing that makes the Fed worried is that the relationship between employment and GDP and inflation is not as strong as it used to be. So if the Fed is using its monetary policy too much, then it becomes less and less effective. And that's a worry for them if we actually do go into a recession. So another measure of concern for the Fed is going to be the low level of interest rates right now. Yes, the Fed has been raising rates consistently for the last year and a half or two, but that's because interest rates were at nearly zero. Why were they at zero? Because we had this huge deflationary spike here during the Great Recession. The worry for the Fed is that interest rates right now are still only about half of where they were before the last time they had to cut to stimulate during a recession. And if interest rates are already fairly low, there's not very far for them to go in case they do have to stimulate the economy. And then it may not be effective and we may run into trouble. So how do we get to this current dialogue where investors, commentators are saying the Fed should cut, where the data doesn't really support that? Well, I think it goes back to December. The Fed was on this raising interest rates path, and then we had a little bit of an inverted yield curve, and we had trade tariff talks, which are not going well with China, and the markets got spooked, and we had this correction in the stock market. The commentators, investors, blamed it on the Fed raising rates too much. And the Fed said, let's take a minute, make sure that we've not done too much, and let's just pause for a little while. Now, in March, GDP came in very solid, but inflation continued to decline, again, mostly because of oil prices. And if the demand for oil is going down because of recession, that is something the Fed needs to be worried about. But it's not a recession in the U.S., it's a recession out overseas. So again, that's not really the Fed's job to speculate about overseas inflation. So the case for raising rates was weakened, but they're not saying that they're going to cut rates. Then we move on to June. Now the dot plot keeps percolating just a little bit down, and these dots are individual Fed governors saying where they think rates should be. And as we go through these 3 periods, we see these dots just sliding downward just a little bit. But even though they have slid downward, here's our medium point right here, is at this little dot. the dotted lines, and still the majority of Fed governors think rates should be the same, or one lonely governor thinks rates should go higher. That's in 2019. If we go to 2020, the consensus begins to percolate up a little bit more, and then a little bit more as we go forward. So the Fed's statement after the June meeting said the current level of interest rates is consistent with their mandate for full employment and stable prices. They did not say they're going to cut rates. They did say the case for cutting rates is stronger, and they're ready to do that if the economy weakens. It's not the same as actually planning to cut rates, which is what you might hear. So how did the markets react to this announcement? They were happy. Immediately, the markets all went up, stock, bonds, US, international, they all went up together and then continued going up for most of the rest of the week. The Friday they declined just a little bit. So the markets responded well to the Fed not changing interest rates, not raising interest rates. I don't think that these investors are betting on a cut, really. They're just happy there's not an increase. But futures investors, this particular subset of investors, are now 100% confident the Fed is going to cut rates in July. What this chart shows you is 57% of investors think rates should go down 1/4 of a point, and another 42.5% think they should go down 0.5%, 50 basis points. Why? There's really no economic reason why that should happen. The only reason would be political tensions. And the Fed Chairman Jerome Powell also said in his press conference that the Fed's history of being independent of political pressure has served the economy well and would continue to do so. So there are definite pressures on him and the committee to lower rates, but the economic data doesn't support it, and they will follow the data. So I don't think those rates are going to go down. And let me just illustrate why that's true. I'm a lonely voice out there in the wilderness. Have you ever heard of that phrase, pushing on a string? What that means is if you put pressure on a string, that string is not going to put any pressure back. There's no static in it. There's no strength in it that's going to allow that pressure you're putting on it to impact anything else. So I'd relate the economic situation to you or me trying to push a sofa across our carpeted living room or a mattress across our carpeted living room. For a sofa, once you get its little feet out of those dents it makes in the carpet, you can move it fairly easily because it's static, it's rigid. You can put some pressure on it and it's going to move. A mattress, if you try and push that across the carpet, a lot of times the mattress bends before it goes anywhere. And that's because that mattress has slack in it. It has a cushion in it that absorbs that force. And that's what we have right now in our economy. There's plenty of liquidity in the economy. Their interest rates are already low. People can borrow money if they want to. So the Fed lowering interest rates would not accomplish any stimulus, but it would perhaps spark inflation. So here's my pro and con, and you can make your own decision. On the reasons for a rate cut, global growth is slow, business investment is weak, inflation is lower than they want, and the futures market expects a cut. On the side of keeping rates the same, the economy's on solid footing, labor markets are tight, and if the Fed actually does stimulate the economy, what you just might get is inflation, not necessarily growth. Interest rates are already low. If the Fed lowers them now, before we need to take action in the event of a recession, then they don't have as much room to maneuver. And finally, there's plenty of money out there. Banks have ample reserves. They can lend money to people. We can borrow money at low rates already. So on balance, the data just doesn't support a cut. So I'm here on record saying it's not going to happen, at least not in July. Barring some really extreme outcome from our trade discussions or wars or other political events that are going to really threaten the economy, the Fed's going to hold tight. So we'll wait and see. I hope you at least have some sense of the things that might drive that decision. And as always, if you have any questions, please send us a note. This has been A Minute with Marcia.